So any questions on that before we move on? Okay, if there are no questions, then we'll move on to, I hope I didn't skip a slide. Okay, we'll move on to the next slide. Yes, so as I was saying, sufficient and appropriate. When we talk about sufficient and appropriate, sufficient relates to the quantity of evidence, like I already said. And appropriate relates to the quality, which is the relevance and reliability of the evidence. So sufficient relates to the quantity. There must be enough audit evidence, to support the conclusion or opinion that the auditor will give. Then appropriate relates to the quality, which is the relevance and reliability of the evidence. Very important. So to answer Caleb's question, the auditor will need to exercise his professional judgment. So that's what I describe as informed discretion. Informed meaning it's professional. We expect that the auditor will be professional. Then judgment is the discretion side. On both of these aspects, you see, so the auditor will need to exercise his professional judgment. Very, very important. In deciding whether there's enough evidence to support a conclusion and assessing the quality of each item of evidence. So that's why you clearly see a professional judgment. Professional judgment. So one of the things is, when is there enough evidence? When is there enough evidence to support? So the questions that Caleb was asking, when is there enough evidence to support a conclusion? And what is the quality of a given piece of evidence? And is this sufficient to justify the audit opinion? All these are questions that would remain within the remit of the professional judgment of the auditor. Now, the two characteristics of quantity and quality are also interrelated. It's possible that an auditor may be able to reach a justifiable conclusion based on a smaller quantity of high quality evidence. It's possible, right? It's possible that the auditor will get high quality evidence, but it's probably in small quantity and may be able to reach a justifiable conclusion. However, a larger quantity of a low quality evidence may be required to reach a justifiable conclusion. Now, what you need to understand here is that you need a right mix of both. In terms of quality and quantity, you need the right mix in order to come to a very, very appropriate conclusion as an auditor. Oh dear. Factors that may influence the sufficiency of audit evidence include the materiality. You cannot talk about quantity without talking about materiality. We cannot talk about sufficiency without talking about materiality. So once we are talking about sufficiency, we'll definitely talk about the materiality of the item being tested. We'll talk about the financial position of the client. We'll talk about the internal control system, as well as how persuasive the audit evidence is. how persuasive the audit evidence is. So these are factors that affect the sufficiency of the audit evidence. Any questions on this slide? I think we've talked about this slide as part of earlier conversation. Sorry, I have a cold. Any questions? Okay. If there are no questions, then I'll proceed. Now, this is one of the most important slides. And as we are going through the past questions, we saw that over and over again, right? And I said you should write them down somewhere. So a number of audit testing procedures are available to the auditor as a means of generate. Sorry, a terrible code. A number of audit testing procedures are available to the auditor as a means of generating audit evidence. And the auditor is at his liberty to use more than one procedure. The auditor is not restricted. And what influences the audit procedure is the objective of the audit. What do you want to achieve? Once you know what you want to achieve, then the procedures are a series of steps to achieve that. The auditor should select the most appropriate procedures in each situation. There are 7 main testing procedures. Please, this one, I've always said it over and over and over and over again. There are 7 main testing procedures. 7 main testing procedures. Number 1, inspection. Number 1 is what? Inspection. Number 2, observation. Number 3, inquiry. Number 4, external confirmation. Number 5, recalculation. 6, reperformance. 7, analytical procedures. So, the way you remember this, because you need to remember it, please never go into the exam without remembering this. Because I know that this is quite important, I came up with an acronym which I have typed in the chat. I hope you all can see it. Can you see it? If you can see, please let me know.
Yes, sir.
Okay. So you can use whatever acronym helps you. But I thought that this one was easy to remember. RARE IOI. So please don't go into the exam without not remembering this. Please. So can someone please, for the sake of the class, mention the 7 audit procedures? Can someone take a shot at it?
Okay, so we have recalculation, analytical procedures, reperformance. Hello?
Yeah, I'm listening now.
There's some feedback somewhere. Okay,
Yeah.
so we have recalculation, analytical procedures, reperformance. The second E, I don't know. So we have
So the second.
No, the E.
The E is external confirmation.
External confirmation. Good.
Yeah.
Inquiry, observation, and
Inspection.
Inspection. Thank you.
Fantastic. Is that Abigail or Caroline? Caroline.
Caroline.
C and C, Caroline and Caleb. Okay. Thank you. Thank you very much. So please don't go into the exam without not remembering this. Otherwise, you'll be seeing stars. You know the way cartoons, they'll go and hit something and there'll be a star around their head. You can't go into the exam because you needed to do a lot of things. At least if you remember this, it helps you in several weeks. Now, I don't know if I should do this and come back here. Okay, I'll come back. So these are the 7 procedures. Now, if you take the procedure, number 1 is inspection, right? So what are you inspecting? When you are inspecting, you are looking at the item. It's like a policeman has stopped you and says, "Where's your license? Let me check. Where's your license? Let me check." Then you remove it. That's inspection. Just like in school days, they used to inspect. They used to do a lot of inspection. They will inspect your handkerchief. They will inspect your fingernails. That's inspection. So you're inspecting something physical, right? You're inspecting tangible assets. You're inspecting documents. And you're inspecting, accounting records. That's inspection. Then you also have observation. Observation. You are sitting back and you are looking at observing events. You are looking at events. So how is this applied? Well, you can watch a procedure, right? So for a lot of auditors, I'm sure you've done inventory. There are inventory counts or stock counts, and there are stock observations where you don't do the actual counting, you observe what is being done. So a typical example would be physical inventory counts, distribution of wages, opening of mail, could be several things, so you watch a procedure. But the problem with observation is that when you're observing somebody, just like sometimes people say in relationships and all that, when you're observing somebody, they can put up a different character that they are actually not. So when the company hears that the auditors are coming, they organize everything nice. And during the observation, they do everything nicely, And then when you leave, they continue their, somebody said, Jumbo accounting. So another thing about observation is that once you are done with the observation, that's it. You go, they can do whatever they want. Then you have inquiry. Inquiry is when you are trying to find information from people who are knowledgeable, people who have the information. You are seeking information. That's what we mean by inquiry. Inquiry. They also have external confirmation. The reason why it's called external is because you are seeking confirmation from a third party. So you are seeking confirmation from a bank. So Kojo Menu Enterprise Limited, in his financial statement, he said he has cash balance or a bank balance of 5 million Ghana cedi. Okay, Mr. Kojo Menu Enterprise Limited, where are your which banks do you save with? Okay, I save with Prudential Bank and Kokobioko Rural Bank. Okay, Kokobioko Rural Bank. Koku Menu Enterprise Limited says he has 2.5 million Ghana cedis. Is it true? Yes, it's true. So that's external confirmation. Then you have recalculation. This is where you are checking the mathematical accuracy.
Okay.
You're checking the mathematical accuracy of records or documents.
Okay.
So here you'll be doing some adding, to check. You'll be doing some adding to check. Hey, I didn't know Lorraine could talk. You'll be doing some adding to check. What do you call it? To check the accuracy of a document or of a record. Then you have reperformance. Reperformance. This is where you independently carry out procedures or controls which were originally performed by the client. That's why we are saying reperformance. So what the client has performed, you reperform it again. Sorry, that's tautology. You reperform it. So you independently carry out procedures. Then you have analytical procedures, which I said we'll come to, right? Which is more analytical, which is like the fun part of audit. This is where you evaluate and compare financial or non-financial data for plausible relationships. Plausible relationships. What do we mean by plausible relationships? It sounds like big English. What do we mean by plausible relationship? Say plausible. Plausible relationship simply means reasonable relationship. So you are comparing financial and non-financial data. So this is where you do things like you compare current year to prior year. You look at the changes, that the changes make sense. Just like what we are trying to do yesterday in the audit class. That's analytical procedures. Analytical procedures. Very, very important. Any questions on this? So you see why this is important and you need this. If you have any questions on this, please ask because it's crucial. Please, any questions? Okay, if there are no questions, then let's move on to, ouch. Oh God. Let's move on to the next slide. Is someone okay? Does someone had a question? Okay, so I was going to talk about financial statement assertions, but I wanted to wrap up on these audit testing procedures. Yeah. Okay. So modern audit theory takes the view that financial statements are made up of a number of assertions or representations. So when we say assertion, what does it mean in English? Let's start with that. What does an assertion mean? Ouch. That's falling in my eye. What is an assertion? What is an assertion, please?
I think a claim.
Fantastic.
Or say what something
Represents.
supposed to represent.
Okay, that's a good one. That's a good one. So anytime, the reason why they are called financial statements assertion is that anytime you see, oh, what has fallen in my eye? Anytime you say, okay, on the financial statement, your AP balance is 5 million Ghana cedis. You are making a claim. You are claiming that it's 5 million Ghana cedis. Or you are making a representation to the world that is 5 million Ghana cedis. That's why we call them financial statement assertions. You are asserting that, or you are making a claim that, that this is the number. This is the number. But assertions are generally characteristics that need to be tested. These are characteristics that need to be tested to ensure that your financial statements are accurate. So let's move on. The auditor should therefore generate evidence designed to reach a conclusion about each of these assertions. These assertions are set out in ISA 315 and fall into two categories. They are income statement assertions and balance sheet assertions. Two types: income statement assertions and balance sheet assertions. So you need to be aware of that. Now let's see. Let's look at these assertions, right? Let's look at these assertions. The first half of the slide is talking about income statement assertions. The second one is talking about balance sheet assertions. So you have occurrence. Now, the assertions, right? they are generally they are about CEVOP. There are 5 of them. That one you need to remember. Every auditor knows it. Every auditor knows it. So I call it CVOP. CEVOP. It's in the chat. Those are the general assertions. If you don't remember, let's say you're hot in the exam, which I know you will not be hot. But CEVOP, completeness, existence, valuation, occurrence, presentation. Yeah, Angela, do you have a question? Anyway. Does anyone have a question? Okay. So number 1, occurrence, right? Occurrence, transactions and events that have been recorded or disclosed have actually occurred. We want to know whether those transactions that we have recorded have actually occurred. They have completeness. So you are looking at the income statement here. Completeness. You are looking at whether the transaction and event has been fully captured or recorded. That's completeness. Is it complete? They have accuracy. Has it been recorded accurately or appropriately? They have cut off, which is we are looking at whether the transaction has been recorded in the correct accounting period. So for example, if a sale was done, if a company has a financial year end of December 31st and the sale was done the following year, right, you cannot record it in the current year. Cut off. You have classification. Here, you are looking at whether the events have been recorded in the proper accounts. In the proper accounts. Ouch, my eye. In the proper accounts. Then you have presentation. Okay. Presentation. This talks about disclosures and whether transactions have been appropriately described and it's understandable. How have you presented it? Very, very important. Very, very important. So you can come up with your own acronyms for these things, but don't go into the exam not remembering it. Please. Now, when it comes to the balance sheet assertions, we have existence. We have what we call rights and obligations. Does the entity hold the right to the asset? So this entity is saying they have 4 mansions in Dubai. Do they have rights? What are the papers that show? So rights and obligations. Then completeness, which we've already talked about. Accuracy, valuation and allocation, right? The valuation refers to the value of the asset. Has it been appropriately recorded? Very, very important. Then classification as well as presentation. We talked about that when we are referring to the income statement assertions. Any questions on this? So if you look at this, right, you see that classification, presentation, accuracy, they are kind of like common grounds for both of them, as well as giving completeness, sorry. The only changes is, it's not a change, but like when you look at it from a balance sheet perspective, you call it existence. When you look at it from an income statement perspective, you call it occurrence. But you see that there's a commonality between both of them. Any questions on this? Hey, no questions on this. Okay, looks like it is well understood. So let's move on to our next slide, which is directional testing. Oh, what's wrong with my eye? Direction. Ouch. Sorry, please give me 1 minute. I don't know. Directional testing. Directional testing is simply an audit approach, right? An audit approach, and it was developed way back, way back in the 1980s. And it has been used for a while now. So what is directional testing? I'm sure you might be asking yourself, what is that? Does anyone have a clue what it is? Directional testing.
No, sir.
I see. No one has an idea. Direction testing. Okay, so as we go along, we understand. This directional testing has a number of advantages. It helps the auditor to clarify the audit objectives, and it helps to focus the audit work. It's a kind of testing that helps the auditor to focus on areas of high audit risk. That's why it's called directional. It gives some form of direction to the test. So it focuses the audit work on areas of high audit risk. So it's those areas that the auditor would be looking at. That's why it's called directional testing. Directional testing has its foundation in the fundamental principle of double entry. So in situations where the trial, there are times where the trial balance will balance. If the trial balance balances, does it mean that everything is correct? Accounting students.
No, sir.
No, sir.
It doesn't mean everything is okay. So what are we saying here? It's possible that maybe a debit entry is misstated somewhere, or a credit entry is misstated somewhere. So if there's a balance like that, what we are saying here, if the trial balance balances, but a debit or credit entry is misstated, there must be a second misstatement somewhere in the trial balance figures, which makes perfect sense. Now, the nature of directional testing. The following conclusions follow on from the point raised in the above example. By testing debit balances directly for overstatement, total credit balances will also be tested indirectly for overstatement. Does that make sense? So if you test debit balances for overstatement, what you've done is based on the double entry system. The double entry system is two-way. For every debit entry, there's a corresponding credit entry. So by testing debit balances directly for overstatement, total credit balances will also be tested indirectly for overstatements. I hope that makes sense.
Yes.
Okay. And by also testing credit balances directly for understatement, total debit balances will also be tested indirectly for understatement. So directional testing is based on the following approach to the audit. If all assets, balances, and expenses for the year are tested directly for overstatement, and all liability balances and income for the year are tested directly for understatement, then misstatements in the opposite direction will be tested indirectly. So that's what we were talking about before. That once you've tested the debit side of things, indirectly, you've also tested the credit side because it's built on the foundation of the double entry bookkeeping system. So the main focus of directional testing, you test debits for overstatement, test credits for understatement. And why do you do this? Because in the statement of financial position, like we've always said, assets are more likely to be overstated. Assets are more likely to be overstated. And liabilities are more likely to be understated. Very, very important. Any questions on this? If there are no questions, then I'll move on. Okay. So testing for overstatements and understatements. A test for overstatement will definitely start with the monetary amount recorded in the financial statement. So the direction of the testing is then backward to its source. And such tests seek to confirm existence. Because remember, when we are talking about existence, we said existence is an assertion that relates to what? The balance sheet. And existence, use it to test balance sheet items. Particularly assets. You want to check whether the assets are existing. So the direction of the testing is then backwards to its source. For example, in testing purchases for overstatement, balances in the financial statements will be traced back to signed goods received notes as evidence that the goods were received. I hope that makes sense. If you want to check out purchases, you trace it back to the signed goods received notes as evidence. They also have the test for understatements. It starts at the source and traces transactions forward to the financial statement. And these tests are aimed at ensuring completeness and accuracy. So test for understatement is going what? Forward. Test for overstatement is going what? Backward to the source. So for example, in testing sales for